DCB Bank just released its results for quarter one fiscal year 2026, its latest quarter. So let's check out some of these results. So first, we have some of the performance highlights of quarter one fiscal year 2026. We have the balance sheet size, which has grown by 19.96% year on year. Year on year means we are comparing this quarter's results to quarter one fiscal year 2025, so 12 months back. So balance sheet size currently standing 77,395 crores, growth of 19.96%. Advances have grown by 21.42%, now standing at 51,215 crores. Deposits have grown by 20.02%. Profit after tax standing at 157 crore rupees. This is after tax. Pure profit has risen by 19.72%. Now, gross NPAs or net performing assets are now 2.98%, a slight decline or a slight improvement over the 3.33% seen in quarter one fiscal year 2025. Here we have net non-performing assets now standing at 1.22%, which is a slight increase from quarter one fiscal year 2025's 1.18%. So there's not a concern, but something to look out for. Then we have the CASA or the current account savings account ratio standing at around 23.32% when compared to uh, quarter one fiscal year 2025's 25.41%, so a bit lower. Then we see capital adequacy ratio 16.66%, which is a higher number than quarter one fiscal 2025, 15.95. So an improvement in the capital adequacy ratio. And here we see the provision coverage ratio finally standing at around 74.04%, a slight decrease from the 76% seen earlier. So profits have grown, gross NPAs have declined, capital adequacy is doing fine, CASA a slight decline, and net NPAs have risen a bit. They've risen a bit. Moving on. Now, the head count stands at around 10,886 people. We have branches, 465 right now. So 20 branches added in the last 12 months. Here we see the branches by state. So let me zoom in a bit. Yes, 19% of its branches in Gujarat, 16% in Maharashtra, 12% Odisha. Then we have the other states like 8% Telangana. So a lot of its branches are in the southern region, South India region, but still fairly diversified. But of course, Gujarat, West Coast, almost one-fifth of its branches are in Gujarat. Here we see, yeah, 28% of its branches, I believe, are in the metro regions, 24% semi-urban, rural, making up 19% branches and rural areas. So, moving on, here we have some more numbers. Deposit profile. We already saw deposits grew by like 20% this year. Let me go down. Okay. Current account and savings accounts. So higher the percentage of current accounts and savings accounts, it's better for the banks because they have to pay less interest on current account and savings accounts or CASA. So CASA 14,469. Here we can see the percentage of CASA. Here you can see 83.9% are savings accounts and a small 16.1% are current accounts. Here we see the term deposits. So first we saw the current account saving accounts, then we have the term deposits. Around 75.9% of term deposits are residential or of residence. 16.4% are now interbank. So between banks, term deposits, which is an increase. It's in this parameter is increasing. And we have 7.7% non-residence term deposits. Next, we have its funding mix. Where is it getting its funding or its the source of its money off? The source of its money. So 68.9% of its funding, it's coming from term deposits, slight increase from 67.6% seen January 2024. Then 20.9%, currently we have CASA ratio, a slight decline. We can see here 23% here, CASA 22.2% and 20.9%. So slightly declined. 7.9% is refinancing and 2.5% very small subordinate debt and others. Here we can see the credit ratings by CRISIL and CARE, a double A stable rating, A1 plus, A1 plus. So highly rated bank or very safe according to the credit ratings. Moving on, we have asset quality. Here we can see the gross NPAs, the net NPAs, and the provision coverage ratio. The provision coverage ratio 74.48% in March and 74.04% in January 2025. So provision coverage ratio, it's slightly declining. We can see here in January 2024 it was 76%, then December 74.76, and now has declined to 74.04, so slight decline. Gross or non-performing assets, so GNPAs, have been declining too, 3.33% here, 3.11% in December 2024, and now 2.98%. But it seems that net non-performing assets have increased from 1.8%, pretty consistent actually. It got down to 1.12% in March 2025, but now is higher now, 1.22 percentage of all loans, non-performing assets. Moving on, we have key credit metrics. Now this is very important. We already saw gross NPA percentage, net non-performing asset percentage. Now slippages, percentage of loans, I believe, which go bad, 4.59. Now this can be concerning. So we already see here 3.67%. Okay, 3% of loans becoming bad, slippage ratio in March 2025. Now in January 2025, a big jump to 4.59 percentage. Here we have the provision coverage ratio, including technical write-off. Write-off here means removing bad debts from their balance sheet. So when banks remove bad loans from balance sheet, that means a write-off. So including technical write-offs, the provision coverage ratio, meaning what percentage of bad loans are covered by its provisions or the funds set aside to cover these bad loans. They covered 74.04%, a slight decline. We already saw this. Excluding technical write-off, meaning all the bad loans which were written off when they're actually accounted for, when they're actually included in this PCR, 59.75%, but provision coverage ratio excluding gold loans is 75%. So this metric, PCR excluding gold loans, is useful too because gold loans really don't require a lot of coverage or provisions basically. But the overall image seems that PCR or provision coverage ratio has been declining. Moving on, we have more key ratios. Yield on advances. Here we have 11.24%, slight decline from last quarter's 11.54. Cost of funds standing at 7.18, pretty stable. Cost of deposits 7.12, not bad. Here we have cost to average assets 2.52, which is a decline, it seems, from compared to the last 4 quarters. Cost to income ratio has declined really nicely to 59.97% compared to 67.89% in Q1 fiscal 2025. Lower this ratio, the better. And return on assets 0.81. Okay, it's pretty stable. It seems pretty stable. Not that much of a decline compared to Q1 of 2025. But compared to like Q4 of 0.95, mm, okay, not the best, not the worst. Okay, okay, this was not to be seen. Moving on, we have capital adequacy ratio. Yes. So, June 2025, Tier 1 makes up 14.2%, and Tier 2 capital makes up 2.46%. So, adding all these, we get the CAR ratio of 16.66%, above the RBI's, of course, minimum requirement. Tier 1, 14.2, higher than 14% seen in January 2024. So more Tier 1 capital, higher capital adequacy ratio, the better. Here we have the risk-weighted assets as a percentage of total assets. Here you can see it declined to 49.34%, a very nice decrease from the 53% we see in June 2024. So that's a nice sign. That's a good metric, positive metric. Now, this is very important. Non-interest income. How much money is the bank making from sources other than loans? Here we can see the non-interest income has seen a rapid rise. In June 2024, 143 crores. In June 2025, 236 crores. A very impressive increase. Here you can see the core fee income has grown from 114 crores to 134 crores in the last trailing 12 months. That's a 20 crore rise, not a 20% increase. If we can use a calculator, and I guess can't find my calculator, but good growth rate even in the core fee income. So its core fee income has been rising. Here we can see the percentage of non-interest income, around 57% coming from commissions, exchange, brokerage, very nice. 43% coming from profit on sale of on investments. So profit on the sale of investments. Okay, the last thing we have is the profit and loss statement. Now this is important and very short also. So net interest income. What is net interest income? Interest it has earned versus interest it has given out on deposits. You can see the growth here. Now 17% growth in net interest income. Very nice. Other income has grown by 65%. Majority of this 65% growth in other income has come from profit on sale of investments. So we should keep an eye on how much sustainability is in these sale of investments. So that's a thing to keep an eye on. But again, commission, exchange, and brokerage income has also grown very well. So that's a good sign. But overall, total income has increased from 640 to 817 crores, a 28% increase overall. Operating expenses, very nice, 13% increase. When we compare this to net interest income and other incomes growth, it's lower than that. So overall, operating profit rose by 59%. Very impressive. However, provisions and contingencies, so reserves for future, it increased by 306%, from 28 crores to 115 crores. But even after that, it produced a very solid net profit before tax and profit after tax of 20%. So I guess that's it. That's it. DCB Bank experienced a very growth quarter, a lot of growth this quarter. It's been continuously hitting 20% growth for the past so many quarters. Not consecutively, but pretty much, 20% high, 19%, 18% growth we usually see. So net profits have also grown that way. And that's it. Hope you have a nice day.